September 15, 2008. It was a Monday morning. Ordinary in almost every way, except that before the day was over, the global financial system would be standing at the edge of a cliff it had never seen coming. Lehman Brothers, one of the oldest and most powerful investment banks in the world, filed for bankruptcy. It was the largest bankruptcy filing in American history. $613 billion in debt. Gone overnight. The images that came out of that morning became iconic. Employees in suits carrying cardboard boxes out of the glass towers of Midtown Manhattan. A century and a half of Wall Street history, packed into a box and carried out onto the sidewalk. Within days, stock markets around the world were in free fall. Credit markets froze. Banks stopped lending to each other. Businesses that had nothing to do with Wall Street suddenly couldn't make payroll. Millions of ordinary people who had never heard of Lehman Brothers were about to have their lives turned upside down. How did it happen? Why did nobody stop it? And what did the world learn, or fail to learn, from the most catastrophic financial collapse since the Great Depression? Lehman Brothers was founded in 1844 and had survived 158 years of American history. The Great Depression, 2 world wars, dozens of financial crises. By the 2000s, it was one of the 4 largest investment banks on Wall Street, employing 26,000 people worldwide. It seemed, to almost everyone who looked at it, like an institution too old, too connected, and too important to ever truly fail. That assumption would prove to be catastrophically wrong, to understand why. You have to understand the machine running underneath the American economy in the years before the collapse. Housing prices were rising relentlessly, and Wall Street had figured out how to turn that into unlimited profit. The mechanism was mortgage-backed securities, banks bundling thousands of home loans together and selling them as investments worldwide. The logic seemed sound. Real estate always goes up. These products were essentially safe, except they weren't. To keep the machine running, banks started lending to people who couldn't afford to repay. Subprime mortgages. No income verification. No down payment. Adjustable rates that borrowers had no hope of meeting when they reset. Lehman didn't just participate in this machine. It accelerated it. Under CEO Dick Fuld, Lehman borrowed aggressively to amplify its bets on the mortgage market to a degree that made even other Wall Street banks nervous. At its peak, Lehman was leveraged 30 to 1. For every dollar of its own money, it had borrowed 30 more. When the housing market was rising, the returns were extraordinary. When it started to fall, the losses would be unsurvivable. The cracks started appearing in 2006 and 2007. Housing prices began to stall and then fall. Subprime borrowers started defaulting in large numbers. The mortgage-backed securities that Wall Street had been selling as safe investments began to lose value rapidly. In March 2008, the first major casualty arrived. Bear Stearns, another giant Wall Street investment bank, collapsed and had to be rescued by J.P. Morgan in a deal engineered by the Federal Reserve. The government essentially forced a sale at fire sale prices to prevent a disorderly collapse. Wall Street took note. If Bear Stearns could fall, nobody was truly safe. At Lehman Brothers, CEO Dick Fuld remained defiant. He believed the firm could survive. He turned down potential buyers. He rejected offers from foreign sovereign wealth funds that might have provided a lifeline. He believed, with a conviction that bordered on delusion, that the government would step in and save Lehman just as it had saved Bear Stearns. He was wrong. The weekend of September 12th to 14th, 2008 was one of the most consequential 48 hours in modern financial history. Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke summoned the heads of every major Wall Street bank to the Federal Reserve Bank of New York. The message was blunt. Lehman is going under, and the government is not going to bail it out. You need to figure out a private sector solution. By Monday morning, two potential buyers emerged over that weekend. Bank of America and Barclays, the British banking giant, both expressed interest. But the negotiations collapsed. Bank of America walked away and bought Merrill Lynch instead, another bank teetering on the edge. Barclays wanted the U.S. government to guarantee Lehman's toxic assets. Paulson refused. By Sunday evening, it was over. There was no buyer. There was no government rescue. Lehman Brothers would file for bankruptcy in the morning. The decision not to save Lehman, whether it was the right call or a catastrophic mistake, is still debated by economists and policymakers today. What is not debated is what happened next. When markets opened on Monday, September 15th, the reaction was swift and brutal. The Dow Jones fell nearly 500 points in a single day, the largest single-day drop since the September 11th attacks. Global markets followed. London, Tokyo, Hong Kong, Frankfurt, read across every screen, on every trading floor on every continent. But the stock market crash was almost a sideshow compared to what was happening in the credit markets. A money market fund called the Reserve Primary Fund, considered one of the safest investments in the world, announced that it had lost money due to its Lehman exposure. Panic spread instantly. Investors began pulling money out of money market funds worldwide, threatening to freeze the entire short-term lending market that businesses relied on to function day to day. Within 48 hours, the insurance giant AIG was also on the verge of collapse. This time, the government did intervene, pumping $85 billion into AIG to prevent a chain reaction that could have brought down the entire global financial system. But the damage was already spreading far beyond Wall Street. By 2009, the U.S. economy had shed nearly 9 million jobs. Unemployment hit 10%. Foreclosures swept through American neighborhoods. The people who understood the crisis least paid the highest price, and it didn't stop at America's borders. Iceland's banking system collapsed entirely. Ireland, Spain, and Greece entered years of devastating austerity. The global economy contracted for the first time since World War II. The government's response was massive and deeply controversial. Congress authorized $700 billion through TARP to stabilize the financial system. The largest banks, Goldman Sachs, Citigroup, Bank of America, were deemed too big to fail and rescued with taxpayer money, while ordinary homeowners received comparatively little. The fury that followed eventually gave rise to Occupy Wall Street in 2011. And the political aftershocks of that injustice are still being felt today, in the aftermath of the crisis. Governments around the world moved to tighten financial regulation. In the United States, the Dodd-Frank Act of 2010 introduced sweeping new rules, stress tests for banks, new capital requirements, consumer protection measures, and restrictions on the riskiest forms of trading. The Federal Reserve received new tools and new authority to act as a lender of last resort to the entire system. The consensus among economists was that the regulatory failures that allowed Lehman's collapse were too glaring to ignore. Banks had been allowed to take on too much risk, with too little capital, with too little transparency, and with almost no consideration of what would happen if the bets went wrong. But the deeper lesson, the one that is harder to legislate, was about the nature of financial bubbles themselves. Every bubble in history has been accompanied by the same conviction that this time is different, that the old rules don't apply, that the asset in question can only go up. It never is different. The rules always apply, and the people who pay the price when the bubble bursts are rarely the ones who inflated it. Lehman Brothers no longer exists. Its assets were sold off, its name retired, its offices emptied. The building that once housed its headquarters in Midtown Manhattan is now occupied by other companies, other ambitions, other deals being made. The financial system survived. The regulations that followed made banks safer, better capitalized, more transparent. Another crisis on the scale of 2008 is less likely today than it was then, though no serious economist would say it's impossible. What Lehman Brothers taught the world, more than anything else, is that size is not safety. That complexity is not sophistication. That confidence is not competence. A 158-year-old institution, one of the most powerful financial firms in human history, collapsed in a single weekend because the people running it confused the rising tide of a bubble with their own genius. When the tide went out, there was nothing underneath. The world paid for that mistake for years. Some would argue we are still paying for it now.